So I think I should let Sonica start off, or let's start with Dhruv. Why don't you talk a little bit about hotel finance? And I mean, S Bank is quite active in hotel finance, right?
Yes Bank is a knowledge-based banking institute, and we have very sector-specific teams. So our team is focused on funding real estate, hospitality, healthcare, and education. So primarily sectors where there is a real estate underplay. In hospitality funding, where one of the first institutes, first banks to realize that there is a significant gestation period in this sector. Therefore, it is very important to structure financing in a way that the cash flows of the project and the loan repayment and the debt stress is matched appropriately. So we're one of the first banks to offer loans in 13 to 15-year tenors. When it comes to mixed use development, we've noticed that there is a significant uptake in the development of mixed use projects. And it's basically a tool to supplement the capital structure of any projects, so as to provide a bit of low-cost capital, and also to sort of diversify the development mix that is being offered. However, when we appraise any project, we rely more on the hospitality cash flows, and therefore the structuring is done in a way so as to suit the requirement of the hotel more than the other components of the project.
Sonica, your Ludhiana property is multi-use, and do you think that mixed use, and you're building mixed use in Bangalore as well, so do you think that's the way forward? And you can talk about finance. You are all about numbers, I know that. So
they actually understand what is the true realities of hospitality in terms of, the huge amount of capital which gets deployed and larger, period required to actually stabilize your operations, and then thereby, first of all, get into the position of servicing interest, and then, of course, the repayment. I mean, despite all, the patient understanding we get from private sector banks, more so these days on hotel funding, not every private sector bank is as liberal on analyzing the balance sheets to understand what is the amount of quantum of debt we can liberally give to companies, the kind of security requirements they have. Primary as well as a huge number of secondary securities is far and large, which means over a period of time that the balance sheets get dried up for loan funding. And if that is the case, it means that the expansion in this industry will go pretty low. The rate of growth of the number of hotels that will come up with will actually come down. And we are already seeing that in the industry. And if that's the case, we as hotel owners, as operators, have to actually look at innovative ways of actually getting in funds, either through an equity route, and that too at the best possible cost of funding. So there are various ways and means of finance, but at the end of the day, the cost of funding is extremely important. And if that's the case, so you're left with some amount of options. One is you go very aggressive on your leverage, which can really stress your financials. And the other is sometimes you actually look at other ways of finance. So a lot of companies, look at ways of finance such as, they already have running projects. So they actually look at discounting their, accruables, which actually comes in at quite a low cost of capital compared to a typical long-term loan that you may take from any bank. The other option is, because that probably might not give you a very large corpus, is that you go ahead with structuring your project such that you're able to manage the mismatch in the cash flows that come about in both stages, during construction, post-construction, and during your repayment time of the initial corpus. So like, for instance, we as a group sincerely believe, because we're not a very debt-aggressive company, that let's structure the project such that if you want, like, we're very passionate about owning and operating hotels, but at the end of the day, it can't have stress on our numbers and our balance sheets. So in Ludhiana, as well as in Bangalore, we did the concept of mixed-use developments, as you just pointed out. And the mixed-use development went about with a thought process that apart from the hotel, where did the market gap really lie? and then you came up with either a product to support it or multiple products to support it. So in Ludhiana, what we did was that apart from the 5-star hotel sitting in that, we got a premium mall and entertainment complex in that, because there was a huge market gap, and it worked extremely well for us. You know, there the EBITDA margins that you get on retail are extremely high compared to what you get on the hotel side. And it starts right from the day you actually launch the development, if you've done it well. So by the time the hotel is actually stabilizing, you've got those EBITDA margins and the cash flows to actually support the stabilizing time of the hotel. Even during the construction time, there are a lot of developers. Of course, we don't believe in the sale model, but there are a lot of other developers who actually monetize their stock much in advance. So they sell their, the retail space. May or may not be a good strategy, but it does give you enough bandwidth to get cash flows in hand. Works very well. So reduces the stress on the project. On overall margin basis, overall debt raising capacities, and also in terms of the negative cash flows that you may have in the company. Bangalore, for instance, when we analyzed it, it has a very good scope on the hotels, but to sustain the hotel requirement on capital, we actually clubbed it with service residences, so you could get a lot of cash flow much before the hotel would even start off. I mean, provided, of course, you launch the residential bit of it. And we also clubbed it with commercial, because that's, again, a very, very, very captive space sitting in over there. And I think it works really well from cash flows, your EBITDA margins that you get, further debt raising capacity, and also doing an LRD, which is, let's say, a lease rent discounting against the property you've already launched to probably build another one. So there's a very positive chain reaction also which starts. So this is prima facie. Without going further into detail and sounding too boring, I'll probably give the panel again to Bikramjit.
Just open it to the panel. I think you have something to say about the way SAMHI does its...
I've worked across various asset classes, would have raised close to about $1.5 billion of equity, about a quarter of that as plain vanilla conventional debt. However, my last 5 years have been very focused on hospitality space, right, as I was part of SAMHI, right? And over there, the focus is on how do we get the cost of capital to the most optimum or most efficient for the asset that we are building. Right, and working over various asset classes, what I've realized is it actually depends on the strategy that you're opting. One way is that you market yourself when you're raising finance as a specialist in a particular field, right? And then you say what we understand, like SAMHI is doing, right? We say we understand hospitality. Thus, we go to banking partners like Yes Bank and explain them that this is our core forte, right? We understand. As strategy in SAMHI, we have acquired 25 hotels in 5 years. And then how we have done that, that's specific to us. We have built ourselves very heavy on equity, right? So we have gone, as she mentioned very briefly, we have gone on the balance sheet route, where we are saying we have a strong balance sheet to support hospitality assets, right? Basis that initially when we're going to acquire an asset, we're going to go low on leverage. As the asset reaches its potential and what we call in hospitality, the J curve is coming to an end where the slope of the line is going up, we go and re-leverage that. However, what is happening is there is another source of capital which is emerging and coming strong in Indian real estate space, right? And that's where mixed use come into play. That is mezzanine capital, right? Although stratification is also an option, like whereby you treat your retail or your commercial like residential, right? You launch it, you sell it, and you use the cash flows to fund your hospitality development. But also what is happening is by mezz and institutional participation coming in, what we can do is we can start filling the gap without even liquidating our assets, right? So if somebody wants to build a heavy annuity business, right, they can go heavy on equity upfront. If that's not an option, you go, instead of 60-40 debt to equity, you go 40-40-20, whereby that 20 comes in form of mezzanine capital, right? Once your asset reaches the stage where the asset is becoming stabilized, you refinance that with debt, where banks will be very comfortable providing debt to an asset which is stable, right? And then you can proceed. So that way, it's very interesting. One can use mixed-use development actually to kind of enhance the scale as well as the source of capital for the asset that you're looking at.
we've heard a lot of heavy jargon, both from Sonica and from SAMHI, and from my colleague Gaurav, both of who are finance professionals, and therefore have spelled out various ways of raising capital. But let me just come to a little bit of the fundamentals of this. When you're building hotels, largely I think the pain points are today the cost of land and the cost of capital, or the cost of finance. These are the two things that are the pain points, because you're acquiring land largely at a very high cost. And then the cost of borrowing is equally high. And when you add these, in more often than not, the returns tend to get very stressed. Now, a couple of things here. When we come to mixed use, I think that mixed use is getting more and more popular, and rightly so, as it is across the world, purely because, as Sonica was suggesting and as Gaurav was suggesting, that when you use the entire land that is available to you for various asset classes, you can help subsidizing the cost of the FSI for the hotel. Therefore, your actual cost of the hotel land or FSI tends to come down a little, which helps. However, the problem continues in this country at the moment is the cost at which we are borrowing. And that is where I think the industry's single largest demand that we continue to make in every forum to the government is to allow hotels to be classified as an infrastructure industry in as much as the RBI's lending norms are concerned. The minute that happens, we will then be able to borrow at much lower rates, and the time to repay the loans, which typically for most banks today is about 8 years. Now, given that a hotel takes 3 years to stabilize and you have to return the loan in 8 years, it is always stressful. And if you hit a cyclical downtrend during that period, you're bound to be in trouble. The second part of this is what my experience or our experience tells us is that in many cases, banks are lending without really doing the due diligence that needs to be done. Feasibility studies and reports are not of the quality that they need to be. And today you find that there are so many assets which are in trouble. We're going to have NPAs in the hospitality industry like we've never had in the past. And of course, one of the reasons is that banks are now being forced to declare those NPAs. Right? So I think we're sitting in a spot where there needs to be a rethink. And of course, we need to have more creative ways, like Gaurav and Sonica were both mentioning, on how to raise capital, how to structure your projects going forward. And it's going to be critical for the success of this industry, because the last thing that you want is many, many assets in trouble. And then ultimately these troubled assets will come into the market as they are now, and they will at some stage, either become sick or get sold at heavy discounts, which is not really necessarily good for the industry. So I think both things are important. Careful planning of what you want to do when you're building your hotel, and to ensure that your cost of borrowing is something that you can actually service.
You are from an operating company, so your view on whatever is being said, because it's quite varied, and also about the topic which is about, is mixed use model the way ahead?
So everything has been said already. But yeah, to add to what the eminent panelists have been talking about, first of all, we are not into either operating or managing any of the hotels. We are a pure play franchise company. So we do not actually end up putting our money down towards any asset or working capital or cost of operating a hotel. Ours is pretty much various different value adds that come on the table, like distribution and access to sales offices, and driving the business on other parameters that drive value to a franchisee. And typically a 40, 50 room hotel owner to 125. But coming back to the subject, To my mind, I think there's, really depends on the location of the hotel. If you're downtown amidst the corporate sectors or where the offices are, a hotel could justify being a standalone. But given the price of or an iconic location, a historical location with some story to tell, then definitely, and there are many places in our country that really justify a standalone hotel, and we have them. But given the price of land the way it stands today, I think mixed land use is probably the way forward, and I see complete merit in, and I think that's a good way to justify the return on investment, and you're not really leveraging just one product over there. There are multiple. There could be a mall, there could be corporate offices, or theaters or entertainment that really lend to the project. And we are typically in the mid-scale segment, and we have hotels that are operating in this with multi-use products and doing extremely well, because it's not likely that the entire project with all the features in it is going to go down. There'll be a curve for the hotel, there always is. There's a curve for retail, there's corporate, there's rentals, and one lends the shoulder to the other, and the project really doesn't settle down on that. And it's like Mandeep pointed out, the first 7-8 years, that's a little tough call. After that, pretty much sails through.